Today, crypto peeking under the hood. Hello again, it's Martin North from Digital Finance Analytics, the latest post covering finance and property news with a distinctively Australian flavour. A few days ago, I was a guest on Adam Stokes' channel, and we discussed live all of the big questions around crypto and the future trajectory. And I made the point in that show that there are some interesting parallels between what's going on with crypto land and what's going on in other financial markets. It's not such a pure tone as many may think. Now, this is a discussion that I think is really important, so I have Adam's agreement to also put an edited version up on my channel, and that's what I'm going to share with you in a moment or two. Just a couple of technical observations. I actually ended up streaming from my setup here to Adam's YouTube channel, and so he came into my system and then I squirted it up to YouTube. And the other thing, which you may or not be interested in, is that it actually took 3 goes to get it all working. The first 2 times when Adam tried to do it from his end, we didn't manage to get it to work at all. So it shows you that going live is not necessarily as straightforward as you might think. And actually you could say precisely the same about cryptos, because my observation, having thought about it and discussed it, is that there are a bunch of issues going on below the hood, and it's important to understand what those are to understand what the future trajectory may be. Anyway, here is the show. I hope you enjoy it.
But in Martin's channel, he's been around a lot longer than me. He's been on 60 Minutes. He's an economist, a philosopher. Martin, thank you for joining us. Can you give my viewers a little bit of a background of how you got into the YouTube space and what your channel is about?
Sure. Yeah. Well, I've been doing, analysis, economics, and for years and years and years, and I really enjoy the synergy of multiple dimensions, including a bit of philosophy on the side, right? And I started getting into YouTube about 4 or 5 years ago. Started making a few shows and quite like playing with the technology too. So I have to say I'm a bit of a geek when it comes to tech, as you may have guessed from some of the things that have been going on. Interestingly, the channel Digital Finance Analytics, or Walk the World, is the YouTube channel, is really trying to take a more philosophical view about the world and economics and finance and those sorts of things, because a lot of economists are very narrow. I try to be much broader. I also try to put, frankly, a more generous perspective and give different views and opinions rather than just say it's like this and you got to swallow my view, right? So great concept of trying to frankly get different views and opinions to come on so people can make their own views. And what that basically means is let people be adults, let them make their own views and opinions, right? So rather than spoon feed, I try to actually help people to grow and develop their own thinking, their own ideas. I'm a philosopher by training, and so I tend to ask the next question, the next question, the next question to try and figure out what's really going on. And I also, by the way, believe that digital is really important, and that your world of crypto and digital and my world of finance and things are actually not that far apart, and there's some very interesting developments into the future. So I'm also interested in that future orientation too, and that's where I think this conversation is really interesting.
Yeah, what I've really enjoyed about your work is actually the philosophical side. So when I first met you and I started interviewing you, it wasn't until after the first interview that I realized that philosophy was in your background. And as a result, I think that's the edge that you have in this space with economists. That is, some economists can get very set in their ways and not step back and look at different perspectives of what's happening around them. And most certainly what I found in the crypto space is that many, I like to call them traditionalists, they're not prepared to let go of the old traditional markets, the financial markets, whether that be fiat or gold or shares or bonds, that was a market that they were very used to. And now that we have these new emerging markets in the digital space of crypto, I've really enjoyed the fact that you've remained curious. And in fact, as I understand, you've even invested in crypto yourself.
I have, yeah. And I did it because I wanted to learn more about it, right? So I believe that the best way sometimes to learn is to go boots in and just see what happens, right? So I did that some years ago, and that's the best way to learn, not frankly to make vast amounts of money. Some people have, some people haven't, I guess, but to learn about it, right? Because learning about it is what I'm really interested in. I'm trying to understand how it works, but also trajectory where it might go, right? Because my own view is the blockchain is the fundamental DNA of a future world that we haven't yet seen. I'm not sure whether Bitcoin is part of that or not, but if you think about it more broadly, there is plenty of opportunity for disrupting the existing financial systems that exist today, which are very inefficient, very much orientated towards the big end of town, and frankly don't often deliver on the promise for ordinary people. And so I'm interested in how that can play out.
Right. So I put a invitation to the viewers out there. If you've got any questions, send them through. But whilst those questions come through, Martin, what was, I guess, alarming or interesting to me in our last discussion was we were talking online in front of the camera, in front of the world, about the weaknesses of crypto with the number of scams out there. And then after our discussion online or in front of the camera, we spoke about the potential for the crypto markets to pull back significantly. Now, I might add, crypto markets seem to roll in 4-year cycles. That is that we have this big pump a year after the halving. So we had the halving last year, and then there was a big run up. And some have said that we're about to have a big blow off in the crypto markets where we're going to see crypto go much higher. Others have said that no, we're going to actually see crypto, or Bitcoin in particular, pull back to a price of $10,000 per coin, which is very alarming. But you mentioned you see potential signs of institutional investors pulling the rug out from underneath us. Can you expand on that a little bit for us?
Yeah, so it was very interesting. I won't mention which merchant bank, but there was a merchant bank that made a big announcement, and they said that they'd actually established a crypto fund for their investors. You know, their sort of wealth end of the market. So in other words, affluent investors, where they were charging them 2% per annum, right? So they're taking money right off the top. Right. So what they're doing is basically allowing people to invest in lots of cryptos, Bitcoin or whatever it is, but essentially managing through a fund. So this is an example of institutionalization, right, coming in over the top. Plus, there are a bunch of people now taking derivative positions in crypto, right? So in other words, a future X price, and taking a position and trading the volatility between the current price and the future price. Now, a lot of people for about the last 6 months, up to about 3 months ago, were making massive amounts of money because of the movements up. Then it dropped. A lot of people lost their shirts and they had to actually deal with those short positions. Now they've come back in again. Now, the interesting thing is this is precisely mirroring what's happening, not only in crypto land, but in gold and silver and in currencies too, where large institutional players are taking positions multiple times the underlying to trade the volatility, right? Crypto is absolutely now in the middle of this. And so the volatility that you are seeing at the moment is being exploited by hedge funds and large institutional players who are effectively doing precisely the same play as they did in some of the other asset classes previously. Now, I don't think that many people, individuals in crypto land, understand this and understand how rigged this market has now become.
You're talking about the volatility of these markets. Now, many people use that volatility to their advantage. So if you're a trader rather than an investor, whether it's going up or down, you can make money, whether you're longing or shorting those positions. Throw in some leverage onto that and you can get some really big wins or losses, depending which way you put your bet down. And I say it's a bet in that instance because, let's face it, it's either going up or down when you're longing or shorting a market and you're hoping for a long or a short position to come to fruition in the way that you have put down that bet. Now, what we have said in the crypto space is that whales are buying up all the crypto in the background. We'll stick with Bitcoin as the primary one. Don't worry about the altcoins for now. And if we put these orders on the open market, so if you have just like you and me coming in and we buy some crypto, we can see that crypto on the market books, on the market orders. But if we put it on over the counter, where we go to these big suppliers, whether that be an exchange, and we sort of do it's not under the table. It's over the counter is an actual term that we use in crypto space, where we're just buying it straight over the counter, so it's not going into the market orders. In the crypto space, we're worried that those purchases are happening in fact, we know that they're happening because we can see the wallets. We can see that Bitcoin is moving from point A to point B. So on one hand, we say that the whales are trying to keep the price down so they can accumulate more of it and keep buying more and more. Now, when we talk about whales, I think it's fair to say that whales are primarily the institutions, because they've got the big money. But if they want to do a sudden rug pull, are they doing that because they want the price to drop so they can short their position?
Well, it depends where they are in the cycle, right? So a lot of people were actually taking positions because they believed that the price was going to go a lot higher. But then it didn't. It went short, right? And so for a long time, the futures price was way below where they expected it to be, and they lost a lot of money, and there were some margin calls and things that came in. So the fact of the matter is that people are actually banking on volatility, right? There's a question of, is it going to go up? Is it going to go down? Now, people will have a particular view on that and will be wanting to maximize the returns based on that, right? Now, in terms of whales, it's very interesting. So who are the whales, right? Are they really institutions, or are they actually people who were founders of the coins earlier on? Interesting question, right? What I do know is that some of those institutional players are now big accumulators, but we also know that some of those are actually the original founders earlier on, who basically are taking, a view. And I also make the point, and this is something which I've come across quite a few times, is some of those people who are, for example, holding Bitcoins are then lending them out to other people so that they can use them and get a return on those lends. That's also happening as well. So there's a lot more going on below the surface than I think a lot of people believe.
Yeah, it's a great unknown out there when we're trying to. Like, I think about our last interview, our discussion, and I was actually talking with my friends about people want certainty in the markets. But of course, if everyone had certainty, everyone would know what to do, and everyone would be rich, and everyone would put their money in a long or short position. But of course, that wouldn't work, because when it comes to trading, someone's loss is someone's win, and someone's win is someone's loss.
You've hit the most critical thing. You've hit the most critical thing of all. Let's just pause on that, right? Every time somebody wins, somebody else loses, right? That is a universal rule of trading, or indeed buying or selling, right? Now, the question I've got is, every time somebody makes money on a Bitcoin, somebody else is losing by definition, right? It's just the way it is, right? That's the thing that people need to understand, right? There's no such thing as money created out of thin air, right? In those things, in those transactions, there's a winner and there's a loser. Just as there is in gold or silver, just as there is in interest rate swaps or anything else, right? There's a winner and a loser. It's a fundamental of the way the markets work. Now, okay, you can gear up. Yeah, you can take a leverage position, and people do that, options or whatever else, right? But even in that situation, there are winners and there are losers. A put and a call isn't the same. In one example, you can lose your shirt, and the other, you just lose your premium. So it's important to understand this stuff, because the point I'm trying to make to you is that the crypto world is as contaminated with precisely these same phenomena as in the other financial worlds, be it gold, silver, whatever, right? So I would argue that crypto is no more transparent. It's as simply as opaque as all the others. And therefore, people who think they know what's going on aren't necessarily seeing the full story. And I know that you can see the movements in wallets and things, but that's a small proportion of what's really going on. And to give you an analogy from gold, if you look at how much gold there are in the current contracts that are out there, and you compare that to all of the other contracts that are not actually linked to the underlying, it's about 50 times as big. Right? Same with silver. So you know that there are lots and lots more people with positions who will have to close out, because there is not going to be enough of the underlying to be able to meet all of those transactions. Now, I think my argument is same in crypto land, and therefore this is a much more manipulated market than people might think.
So what you're saying then, it's fair to say, because what I think what happens is many people hear this commentary around crypto, and they're like, oh, he hates crypto. And I don't think that's what you're saying. I think you're saying that the same type of, shall we say, manipulation or vulnerabilities are true in any markets, whether it's gold or the digital gold of Bitcoin.
Yep.
But it's just that it moves quicker and further in the crypto space.
Well, partly, but I'm also saying that the mythology of crypto land is it's all completely transparent. You can see everything that's going on. Therefore, there are not the same shenanigans and risks. And I'm saying, well, I'm not convinced. What I'm seeing is precisely the same behaviours, precisely the same things going on as I see in the gold and the silver and the interest rates and the currencies. And large institutional players from investment houses, investment banks, hedge funds are playing the same way that they've played traditionally in all the other markets too. Right? So it's very interesting listening to people in crypto land saying, it's great, good to see that the investment banks are now waking up to the opportunity of crypto. I've seen that written 100 times in the last 2 months. No. They've woken up to the fact that they can make precisely the same plays and precisely the same profits, hopefully, that they could in these other ones, right? It's not necessarily goodness, right? And to give you a broader example, if you understand derivatives broadly, right, the total amount of derivatives across the whole financial system is something like 10 to 20 times the underlying in the system, right? So there's a lot of manipulation, there's a lot of fudging going on. And by the way, this fudging is actually endorsed by central banks, and it's endorsed by the Bank for International Settlements and everybody else as part of the architecture of the financial system to allow greater liquidity. It's funny how they often say that, right? My point is, if you are an individual investor and you don't get some of this other stuff that's going on, you could be actually walking into a bit of a bear trap, because there are potentially people who have better information, can trade earlier and quicker and more effectively, right? And I'm saying that as the crypto thing gets more and more developed, this is going to become more and more of a bigger issue in crypto land.
Now, does this mean that you have dare I say, a forecast for what could happen by the end of the year? Because typically, looking at the history of Bitcoin, on every September, something big happens. Typically, it's a bit of a pullback, but there has been a couple of times that it's really pumped. So it's really a real make or break time is September for Bitcoin. Do you have any forecasts, either within the Bitcoin markets or the traditional markets, of what's going to happen over the next 3 to 4 months?
Well, I think there's a couple of questions. The first question is, will the Federal Reserve taper or not? I think they won't. Jerome Powell came out last Friday, and basically, I think, put that to bed for a bit. So we're going to see more quantitative easing in the real world. That basically means that it's unlikely in the short term that we're going to see a trajectory change in the stock markets, right? So I think they'll continue to bubble higher. My view is that there is a significant linkage between the bubbling higher of stock markets and quantitative easing and the trajectory of cryptocurrencies, particularly Bitcoin. So there is, I think, a reasonable chance that Bitcoin will go higher in the short term. I know you've suggested 100,000. Well, maybe 100,000 US. I'm not sure, but I think there's definitely some leeway. What's it? 47,000 at the moment, isn't it? Last time I looked, right? Interesting though, Ethereum has done even better more recently. Fascinating. We could talk about Ethereum versus Bitcoin perhaps a bit later. But how much of that is just the pure simple plays of people buying and selling and trading, right? And how much of it is this overlay of derivatives and positions, right? That's I can't tell. Nobody can tell. And I noticed a couple of people in the chat were saying, well, hang on a moment, isn't the whole point about Bitcoin and cryptocurrency it's completely transparent? I don't know whether the options on Bitcoins are reported anywhere. Do you know?
Well, there's so many different markets to do. So actually, that's a good question. Let me look into that.
I think it's worth thinking about, because look, the chances are there will be people creating derivatives off Bitcoins, in different locations, right, for their own purposes. I don't believe that will actually be transparent or visible just as many of the other derivatives are actually not transparent and visible in other markets, right? So as soon as you start understanding the way that these markets are actually rigged, and I use rigged in inverted commas, right? Because of these players with massive amounts of balance sheet capacity and massive amounts of ability, a lot of modeling capability and a lot of ability to be able to trade really, really quick, that's one of the reasons if you go back to, the stock markets, right? People are actually getting close as they can to the exchanges to get the microsecond trades. In other words, they can make a trade quicker than other people, right? And that's reality. That's, people have spent billions and billions of dollars to be able to get huge pipes and get really, really close to exchanges, right? And then you've got this other thing called dark pools, right? Dark pools are, in stock market land, right? There are people who make big trades before the rest of the market sees that they've traded, right? So when you as a retail investor go into the stock market and you actually think that you're trading at the best price in the market, you don't know whether there are actually a whole bunch of dark pools at a different price. That doesn't show till later. So it's a two-tier market, right? I worry that crypto is going the same way, that individual retail investors in crypto land will effectively become second-class citizens, and some of these other players will effectively institutionalize it to Billio and create precisely the same edifices that we're talking about from the other markets. And again, using my philosophical mind here, I'm thinking, why is that not going to be the case? There's nothing to stop it. It's completely unregulated.
That's right. But what confuses me, and I'm glad you pulled out the philosophical part, because going into deep thought experiments, I thought about this. Many people get so angry at Bitcoin. They get so angry at the crypto markets. And I think there's a few reasons. I think one reason is they don't understand it. Two, they've been scammed, which is quite common. They've gone to the wrong place, they've been scammed, so they're scarred from it. And I understand that. But then you've got, I guess, the third thing is that they see other people getting rich, but it's not them. Now, I want to relate this back to the traditional markets. I remember watching a documentary that you spoke about where hedge funds or trading platforms will position themselves very close. And I remember one scene in particular that instead of sending the signal via a cable, even fiber optic, they had a tower where they were shooting like a laser beam signal directly to the exchange, so they could get there quicker and get those trades in within milliseconds, beating those people before them and getting better returns. Now, what I don't understand is why are so many people angry at Bitcoin, where in its infancy that type of play is not happening per se, but in the traditional markets, exactly as you just pointed out, people are physically positioning the buildings closer to the exchanges so they can get quicker returns, better returns, and being that. Why do you think there is greater anger towards Bitcoin, a market that is accused of being manipulated, than the traditional markets that we know are always being manipulated?
Well, now you see you're hitting exactly the right point, right? A lot of people in the traditional markets, up until very recently, never understood the Bitcoin world, right? So they tended to either dismiss it as just a sort of a fad or a flash in the pan, right? But the point is it's changed, because now we know we've got a number of hedge funds and a number of investment banks who started to wake up and start to see that they can apply precisely the same positions as they do in other markets to the crypto markets. So in other words, it's not so much that crypto has become of age, it's just it's now recognized that they can do precisely the same things as they did before, and they can actually do it as little better because it's all digital, and they can do it quicker because, of course, it's quicker because it's digital, right? And there's a lot of money at stake, and a lot of these hedge funds are actually, deep in, right? So in a way, what's happened is it's this coincidence of the old world, new world, right? I would argue that all financial markets are manipulated. All financial markets are skewed in favor of those with large investment budgets, large amounts of capital, and frankly, ordinary investors, be they retail investors or any other sort of investors, are always second-class citizens, right? My worry is that we could have precisely the same happening within the Bitcoin world and in the crypto world. And I'm not sure that the structure of the crypto markets are sufficiently robust and sufficiently built to be able to withstand some of these broad attacks, because I think they are attacks, right? But you're right, these other markets, gold, silver, stocks, currencies, they are all heavily manipulated. And unfortunately, it's institutionalized manipulation. It's accepted as just part of the furniture, right? And it goes back to what I said a little earlier on. A lot of people argue that it provides more liquidity to the markets and therefore it gives you a, quote, better price. No, that's not true. What it is doing, it tilts the playing field to a particular sector of the market who are particularly well capitalized, particularly well informed, and who can frankly milk the markets relative to other people. My worry is that crypto, in its current evolution, could be going precisely the same way.
So what's the solution? I mean, I just want to shout out to the crypto enthusiasts there that I need to emphasize that what Martin's saying is that it's not an attack on Bitcoin. It's a reality of all markets are manipulated. We've been in this little Goldilocks zone where we've just had retail investors having the advantage of lower market caps, so more volatility in the sense that you can catch a bigger wave into the financial door per se. B, it's more inclusive because there's been minimum buy-ins of a cent, whereas in the share space, you've got minimum buy-ins of typically $500. But again, and this is why I brought Martin on tonight, because that was very alarming to me. Everything that you're saying here is that, in fact, we're now about to get contaminated by the dirty plays that are happening in the traditional markets. So, Martin, what's the solution? Where can we put our money, or what would you do?
Well, here's the rub, right? There is no such thing as a free market. There is no such thing as a market that is not actually contaminated with a lot of these derivatives and these big players who can manipulate the markets, right? I'm afraid that's just reality, right? So you can't think of crypto as a pure tone relative to all the grubby tones elsewhere right now. It's all the same. It's got the same DNA. And the reason it's got the same DNA is because it's human beings, all the greed and everything else. It's the same stuff, right? People are looking to make a quick buck. People will actually do whatever they can to try and maximize their positions. And some people in these large institutions and hedge funds are being handsomely rewarded with massive big bonuses if they can outperform, right? That's what you're competing with. So I'm not sure there's anything much that we can do about it other than, one, we should be aware of it. So, don't assume that there's nothing going on in crypto land like this, because I can tell you it is going on, right? From the very simple example where an investment bank is charging 2% per annum, as I mentioned earlier on, to allow their net wealthy customers to actually go and trade crypto, right? Well, why would you pay them 2%? Well, because the investment bank thinks it makes a good return. That's the simple end, right? Right the way through to some of these more complex derivatives and these positions and all those things, right? I also just want to come back to something else I said earlier on and just underscore it again, right? I know that there are some founders who are early in the development of coins who actually hold those coins and then lend them out to other investors to make a turn. A big turn, actually. They charge them quite a lot to do it, right? So that's another example of, again, financial engineering based on the back of the underlying coins that we've got, right? So that is precisely the same things that go on in the other side of the fence, as it were, in more terrestrial financial markets too. It's been going on for a long, long time, right? Where people lend out money and, get a return on that. So there's nothing new under the sun, unfortunately. And I guess the point is, one, be aware of it. And two, need to factor this in when you actually are reading, as I said earlier on, people saying, well, isn't it great that all these investment banks are now taking an interest in crypto? Yeah, I understand what's going on, though.
Yeah. Yeah, it's alarming to me, and it's really got me thinking, particularly as a commentator in the crypto space that I mentioned before, Richard Hart, who's done very well in making predictions on Bitcoin's price, and his prediction is that it could be uh, as low as $10,000 by the end of the year. Now, I don't know, and no one really knows, but it's just, it's still the wild, wild west out there. And I guess this leads on to I really want to ask your thoughts on the future of gold. So, my argument when I've been on your channel is the reason why gold can't be the global currency is because you can't move it. I can't go to the supermarket or online and use a block of gold. So, then the extension of that is that we make some type of gold certificate, which represents some type of unit of account that says this is a piece of paper that says there's a piece of gold in a vault. Now, of course, that was banknotes, which linked to the paper money that we use today. But now that we've had gold delinked from fiat, or fiat is a standalone currency in itself, what is the future of gold in the financial system?
Well, it comes back to this big philosophical question, right? Which I call the value anchor, right? Which basically says, where do you pin the value of everything else to? What, is it gold? Is it the US dollar? Is it, cryptocurrencies, Bitcoin or whatever it is? Or, is it something, is it seashells, right? That's the fundamental question, right? And a lot of people, Peter Schiff, I interviewed him last year on my channel. Peter is of the view that gold ultimately will be the value pin. Everything else should be measured against gold. Gold will ultimately rise because effectively everything else is being debased with all of the quantitative easing and all of those things, right? So that's one school of thought. Another school of thought is to say, no, actually it's the US dollar that's the value pin, because ultimately it's backed by the Fed, it's backed by the most powerful economy in the world, and everything else then has to be measured relative to the US dollar. Other people will say, no. All of those fiat currencies, they're all being debased to bilio because of all the quantitative easing. So we need something else. And that's when, of course, the argument comes, well, maybe it's Bitcoin or another cryptocurrency because it doesn't have some of the same characteristics, except I'm arguing that, well, hang on, maybe there are more of the same characteristics than you might want to see, right? So none of those assets are necessarily guaranteed to provide that value pin, in my view, because they're all wobbling around. Here's another example, right? Why don't you take the value of one house as the value pin, right? Now, if you take the value of one house as a value pin, well, if you think of what's happened to the value of Bitcoin relative to one house, it's actually been devalued relative to the house, right? Whereas, in fact, dollars have gone the other way, right? So, I mean, how do you actually know the value of anything?
Well, that's what we've spoken about. What I take it a step further and say, well, what is intrinsic value? Because when you spoke with Peter Schiff, and I've really enjoyed listening to Peter Schiff's work, because where our three worlds align, so your world, my world, and Peter Schiff's world, is that we all have a frustration with fiat. We all acknowledge that fiat is being printed to an oblivion and being devalued by endless printing. Where we are different, though, is that we all have a different path forward of what the solution is. So, and this is why I really enjoy learning from you and Peter Schiff. Not that I agree with Peter Schiff, his main argument is gold will be the money of the future.
And by the way, he has an interest in selling gold.
That's right, yeah. I'm glad you raised that point as well. So I remember he was on Joe Rogan's show and he pulled out a gold credit card. And it was, in my mind, it was so hypocritical, because he was saying this is an old credit card, and Joe Rogan held it and it was heavy and it was a piece of gold. And my argument, because I actually commentated that video in a piece where I sort of pulled the argument apart, I was like, it doesn't matter what the credit card's made out of. The credit card can be made out of mud, as long as it can some way be slid over a chip reader, because there's got to be a chip in there somewhere where it says, yeah, this is now linking to a digital money. So on one hand, he was saying gold is the future because gold is so finite and it's the money of hundreds of years, and check out my credit card that's made out of solid gold. But it's like, well, hang on a second, that piece of gold that's a credit card doesn't mean anything. In fact, it's just a liability, because now you're carrying around a big, heavy piece of gold that you can't actually cash in for anything. And if you lose it, you're losing a lot of money there, because you've now just lost a piece of gold.
And
so
you
then we
can't
go
eat, and
back
you can't
into
eat gold, of course. You can't eat gold, right?
Well, that's right, and that links, in fact, to what is intrinsic value. Now, if you and it's an old analogy, but it still stands true. What's worth more, a glass of water or a block of gold? Well, if I'm in the desert and I'm dying of thirst, a block of gold means nothing to me, and I'll take that glass of water. But if I'm in a first world city and I want to go shopping at Louis Vuitton, or there's some type of op shop where I can cash in the gold and I can get water anywhere, I don't want that bottle of water. I want that block of gold. So what is value? And that's why I go back to when you said, I still don't know the value of a Bitcoin. I say, well, during our last recording, the value of a Bitcoin was $70,000. And I say, well, the value of a Bitcoin is $70,000 because it's $70,000. But this is where you and I see completely eye to eye, is that, well, what's the value of a US dollar? And the US dollar, you can see this big circle. And this is where philosophy comes into the markets. It's like, well, what is the underpinning value? What is intrinsic value? Is there even such a thing as intrinsic value? And then I'd actually like to bring in Andreas Antonopoulos' works. He says that money, at the end of the day, is a language. And I actually really like that analogy, or this synopsis, or the description of money being a language. In the first instance, when I go overseas, do you remember when you could use to travel? So back in the olden days, there used to be a time that you could get in these big silver tubes or metal tubes with wings called aeroplanes, and you could fly overseas and go on holidays. And during this time, you could go to any market anywhere, let's say the third world, and I could pull out a $20 US note, and we were speaking the same language. And we were really seeing, you could point at an item, you could hold up a $20 note or a $2 note or a $1 note, and we had a language that we understood, even though we were from different cultures, we were different colors, with different languages, perhaps even different religions. We all spoke the same language when we held up that US dollar. But now that we move into the next phase of money, are you concerned that the US dollar is going to collapse? And if it does collapse, what's the replacement?
No, it's a very interesting question. Of course, lots of different opinions. I mean, a couple of years ago at Jackson Hole, the then Bank of England governor argued that the US dollar was not going to be the long-term underpinning currency. And he said it might be the yuan, although I think that's unlikely, particularly now with what's happening in China. And he argued that, well, maybe it should be a digital stable coin that would actually become effectively the replacement for the US dollar, right? And he was quite specific. It wouldn't be a cryptocurrency. It would be a central bank digital currency, which would effectively be a stable coin. In other words, linked to a basket of other currencies, right? So that was one view. And there is some reason to think that if the Fed continues to quantitative ease the way it goes, it's been doing, 120 billion a month, and probably going to do it for a lot longer, then essentially it means, well, what does it mean? It means that effectively the number of dollars in circulation is going up. Now, traditionally, people will say that means it's going to be potentially inflationary and therefore you're losing value, except that everybody else is doing the same stuff. And it's interesting. Bank of England, right? If you look at the Bank of England, they are roughly now in the UK at 100% of their GDP in debt, right? Of that debt, 35% of it is held by the Bank of England, right? So just think about that, right? The 35% is held by the Bank of England. That's one side of the balance sheet, and the government basically is on the other side of the balance sheet. So there is an interesting argument to say, well, why don't they just sort of knock it off by 35% then, right? Because it's completely artificial, right? They've lifted both sides of the balance sheet and it's just got a bigger number. Now, if that bigger number thing ends up being the story, and I think it's quite likely to be, because I don't think any of the central banks are in the position to stop quantitative easing. As soon as they do, the stock markets will collapse. And I've been saying for some time that the risks that I see are that stock markets ultimately will just start caving in at the point when central banks stop the magic money printing, right? So In that scenario, there is an argument to say, well, the US dollar could still be, therefore, the fundamental point of value into the future. There's another argument to say it's going to be replaced by something else, be it a stable coin, a central bank digital currency. Or maybe it's going to be something very different. And, there are people who believe that what's really happening is we're being softened up. And all of this sort of quantitative easing is basically to create, ultimately, a new central currency, which will be effectively a global currency that will probably be some digital, variant of what we've got at the moment, something new. And people are even pointing to the special drawing rights, which is what is done within the IMF. Well, they're putting a lot of quantitative easing and special drawing rights into the system too. So everyone is just creating this bubble, right? More and more and more. Now, going back to my question earlier on about, well, what's value, right? At one level, what's happening is they're creating more and more and more dollars. And so you'd argue that those dollars are chasing the same amount of goods and services, and therefore the price should go up, and that would be inflationary, right? Except that's not what we're seeing, right? The inflation over the last year or so has been transitory. It's coming back. I mean, look at lumber. Lumber went massively high and has come a long way back. So, those are some of the things to think about. But in terms of what the element is that ultimately becomes that value pin, that source of value, it's very hard to know. I'll also make one final point on this.
Yeah.
Go on.
Let me think about this stable coin. So in the first instance, we know the stable coins that exist at the moment are pinned to the US dollar. So we say that it's stable in the sense that it's pinned to a value that people are comfortable with. And we're comfortable with the US dollar because that's all we've known for the better part of half a century, let's say. But now that we know that the US dollar is declining because they've printed 35% of all US dollars in the last 12 months alone through quantitative easing. But so now we come up and say, well, now we're going to have a stable coin that's linked to a basket of goods. Now, Libra, Facebook was going to do the same thing. So Facebook was going to come up with the Libra coin. And the only reason, let's face it, the only reason why that one wasn't accepted is because it was a private entity. And if Facebook was successful in launching their coin, they would have been the biggest bank on the planet by far overnight. Overnight, they would have had more customers than many of the greatest financial institutions in history combined. So they had to stop that for whatever reason, for right or wrong. So then we say, okay, well, we're going to make a stable coin, which goes back to the government making a stable coin or a Federal Reserve. Now, if it's a Federal Reserve, we know that the Federal Reserve is neither a federal entity nor has any reserves. So if the Federal Reserve is printing the stable coin, we are in the exact same situation where you have a centralized third-party body that is not elected by the people and has no reserves of anything, printing money in exchange for debt. That's one option. Now we say, okay, now the government's going to make the money, so we have no Federal Reserve. They're just going to print the stable coin. They're going to link it to a basket of values, of other things that are constantly going up and down in value anyway. And you can see how this is linking back to what is value, what is the linchpin to all of this, what is it anchored to? So on one hand, we either have a Federal Reserve printing money, and if you want to call it a stable coin or fiat or zeros and ones, it's kind of the same thing. Or we have a government printing the money. And then we have the third option, and this is where I get excited and have hope, is that we have something that's called Bitcoin that is not printable. It's mineable, but only up to a certain limit. It's divisible by 100 million parts. It's fungible and transportable at arguably the speed of light to anywhere in the world without the need for an intermediary body or a centralized, potentially corrupt body. Everyone can see it. It's open and immutable. I just don't see how a stable coin by anyone could survive in the future unless we're going to accept that we're just now doing another version of fiat, which is a digital fiat, which I argue that we're already at.
Well, the fundamental question is control, right? All of the central banks are shit scared, if I can use that phrase on your channel, of losing control of, money laundering, all of those things, right?
Agreed. I have no argument with you there, except for the money laundering part. They laundered money for terrorists, but
oh, of course. I mean, and I know that some of the biggest banks in the system around the world are some of the biggest money launderers there are, right? It's institutionalized money laundering.
That's right.
That nobody wants to admit, right? I think it's a bit another example of old world, new world, no change. It's all to do with the fact that we've got the same sort of characteristics within the system, right? So, but the point there is that the whole idea of control, right? So, governments and central banks do not want to lose control of money supply, who can spend, who can't spend, etc., etc. And in fact, if you look at China is probably furthest ahead in terms of the digitalization of its economy, with social scores, with digital wallets, with digital money, etc., etc. But that's all controlled by the government, right? Gives you complete control. You can basically turn people off, turn people on in terms of their ability to trade and to be able to buy stuff or not, and that means you've got complete control. So that's sort of one world. The other world is a completely devolved, decentralized, individualized future. Whether it's Bitcoin or whether it's some other instance of a digital currency, right? Where effectively the value is actually contained, in an immutable way that isn't actually controlled and controllable by anybody. Now, that's a very attractive alternative. Well, it's attractive to individuals, but it's very, very unattractive to people in power, governments, central banks, central bankers, people in fraud, control, and all those sorts of things. And that's really the tussle that we're playing out here. Plus, of course, my point, remember what I said earlier on? There are now players playing the old game in the new world of cryptocurrencies and Bitcoin, and presumably doing exactly the same. So even the world of crypto and the world of Bitcoin is not necessarily as squeaky clean, immutable, etc., as many people would want. And that's, again, an unfortunate truth, right? So it's almost like, is it really so old world, new world? Or is it more of a continuum? And is it all part of the same DNA? Are we actually stuck with some compromised system, like it or not? Whether it's crypto, whether it's not crypto. And I said, I think, earlier on as well, I'm a great believer in the blockchain and what the blockchain can do in terms of the ability to do transactions efficiently and immutably and, all of those things. I'm a great believer in that. I'm not necessarily convinced that the current instances of Bitcoin solutions that are out there are necessarily those that will ultimately win out at the end of this game, however long the game takes, right? And that's part of the confusion and the difficulty. And again, I guess because I see so many similar characteristics in all of these different markets and all of these different behaviors and dynamics, that I just don't think it's as clean cut as old world, new world. I think it's bleeding one into the other.
It's concerning that I'd like to read a quote to you that was actually said to me by one of my subscribers a long time ago, and I would like your response to it. So it says, "Let me get this straight. Martin wants a money that looks like Bitcoin, acts like Bitcoin, and is decentralized like Bitcoin, but is not Bitcoin." What are your thoughts on that comment?
Well, what is the purpose of Bitcoin, right? If you go back in history, Bitcoin was a payment platform, then it was a store of value, then it was digital gold. I'm not sure what it is this week, right? I mean, that's the first point. So, what is the purpose of Bitcoin in the first place? It depends, right? First point. Second point is, I hear a lot of people say, well, Bitcoin is a long-term store of value. It's always going to go up. Well, maybe, but look at the trajectory of Bitcoin over the last 5 years. It's gone up, down, up, down, up, down, right? Very volatile, not really a store of value. It may well be a speculative vehicle, and I actually believe it is speculative more than anything else, frankly. And that's okay. People want to trade it and speculate with it, fine, but don't try and pin to it the moniker of the next replacement for fundamental money, because I don't think it cuts the mustard, frankly. The other point I'd make is that, and I'm being provocative here deliberately, okay, so just
that's all right. Yeah,
calm down.
I love it.
And I'm probably more provocative on your channel than I would be on my channel, but that's okay. The point I'm trying to make here is that there is no silver bullet solution to any of this stuff, right? And it's partly because it's made up from people that are, by definition, not necessarily always thinking clearly and have lots of different motives and all of those things. But what I'm worried about, Adam, is this, that there's a whole swathe of people who've come into crypto relatively recently. Maybe they got their check from the government when the coronavirus hit and all those sorts of things, right? And have come in and they've made some big assumptions about the way that cryptos work, and they've made some big assumptions about they're always going to go up and always going to make money, right? And I worry that people are actually going to find out the hard way that it is not as simple and as straightforward to actually play this crypto game as many people think. And I do worry that some of these newbies who've come in are effectively being milked by the players who've been around a lot longer and those institutional investors that I mentioned earlier on who are looking for the mugs, right? I worry that that ultimately will be something which could kill off a lot of the potential of crypto, including, frankly, Bitcoin, right? And I am concerned that people have wandered into this without fully understanding that there are scams, there are risks, there are a bunch of people manipulating the markets, the trajectory is uncertain, the volatility is very high, and it's not going to change anytime soon. And yet people claim, almost like a religion actually, that this is the future, and it's almost, frankly, I made a post about a year ago saying, do you realize that really crypto believers, it's more like a religion? They believe it because they believe it because they believe it, right? And I just want people to actually be a little bit more methodical and just think about the upside and the downside and try and get a more measured view of the risks, because I think that's really important with all of this stuff, whether it's crypto or what.
Yeah, look, this is powerful stuff, and it's powerful because I want to expand what you're saying on what is Bitcoin this week. And in one instance, I really understand what you're saying about the speculative investment. So people have some money, not much or a lot. It doesn't really matter. And that's why I like Bitcoin, because it's so inclusive. You can either have a lot of money or a tiny bit of money, and you can be in this market. So on that instance, it's a speculative investment, just as property is. And for some people, just as gold is. For me, gold is not a speculative investment. I've got a comment there from Crypto Crazy. Shout out to Crypto Crazy, who's been on the channel before. He was talking about the performance of gold. Now, gold does not perform. Gold just holds a constant purchasing power. And you know what? I'm cool with that. If I want to protect my money from inflation and I just want to park it somewhere, I'd park it in gold, except for the fact that gold is heavy. I have to store it and it's not fungible. I can't move it around very quickly, but it is what it is. Now I translate that to Bitcoin. If I just want to park my money somewhere in Bitcoin, I certainly acknowledge the volatility of it going up and down, up and down. But if you look at it over time compared to fiat, it's continually going up. It's going up and to the right. But then I go to the next step, is that when I'm doing business on the international stage, I now demand that I'm paid in Bitcoin. Now, that's my choice, and it goes back to what is money. It's a language, and the language is for me that if you want me to do work for you, you will pay me in Bitcoin. And of course, there are exceptions to this rule. And when I was working, I've discussed this on a video previously, I had someone once edit one of my videos, and they wanted me to pay them in US dollars via the Western Union payment platform. And mate, it was an absolute nightmare. It was an absolute nightmare because it took me more time to fill out the details of the Western Union demands than it did for the person to actually edit my video. They needed an address, then a phone number, then the address of the bank, and then the address of the banker, and then what the banker ate for lunch on Tuesday. It was just getting so silly that it took me so long. And in the end, I said to the guy, I said, I've had enough of trying to give this money to you. You give me any crypto wallet address that you want of any coin, and I'll pay you immediately. And he came up with a Bitcoin address. I did the transfer in about 90 seconds, and it was done. So this is where I actually do see Bitcoin on the global stage, and it doesn't have to be Bitcoin in this instance. It could be any cryptocurrency, where I can send value from point A to point B instantly for almost free. Now, if you don't want to deal with Bitcoin and you just want to deal with a stable coin, that's fine. And in fact, many people are doing that now, as we've discussed before, is that instead of putting their money into Western Union, paying the big fees and waiting 3 days to go from point A to point B, they can simply just put it into a stable coin. They don't have to worry about volatility. It's pegged to the US dollar, and they can text it from themselves to anywhere in the world for virtually free instantly with a push of a button from their phone without even leaving their bed, as opposed to going to Western Union and waiting in line. If Bitcoin or crypto, now I expand further, if crypto has that power to be a money network where I can peer-to-peer send money from me to you without a third party, what's the weaknesses of that?
Well, it's an interesting thought, but why don't you use PayPal?
Look, hey, great question. And I'll tell you, I can answer that for you. PayPal can stop and block and freeze my transaction. Okay, so if I want to pay, and I'll give real life example, and this is where I love the philosophical side of you. We know that freedom of speech includes freedom of association, and freedom of association includes the freedom of commerce. Now, of course, there are exceptions to this where I can't go and buy terrorist stuff to do bad things, and that's fine. We have, if I want to look at a simple extreme, is a gun. I can't just walk into a shop and say it's my freedom of association or my freedom of commerce to buy this gun. There's a line there, and I can't do that, and that's fine, and no one's really arguing with that. But there have been instances where PayPal said, well, I can't donate to a channel. Let's just say it was your channel. Let's say you said something that upset people at PayPal, and I wanted to donate to your channel. PayPal can and has and does block transactions, and that's where you have a non-elected, centralized third party stopping my freedom of association by simply blocking my account. And it's even happened to me, even when I've done nothing wrong on PayPal, for whatever reason, they've said, no, you haven't got this piece of paper. We've stopped your account. And I'm like, oh my God, I've got to make this transaction right now. So suddenly I can't move my money. So that's one reason why PayPal can't be used. The second reason, in my argument, and it's a great question, is that we're going back to fiat. We're going back to a money that is declining in value, and I can only use a fiat on their platform. But of course, PayPal is wise, and they're including cryptocurrencies onto their platform. So my simple answer to that is that forget about the speed, forget about the value. What are your, and I think this is where we share values. When it came to the cash ban, you and I had the same issue with the cash ban, that we didn't want Australia banning cash.
Yep.
And cash is a freedom of association where I can just give you $50 for mowing my lawn. Now, one argument is now the government's not getting their cut in tax. The other argument is, well, I could be doing bad stuff with you, terrorism, drugs, whatever. But cash is a fundamental democratic right that we have in our society. And if I have to go through a third party, whether that be MasterCard, a bank, PayPal, FPOS, and they can block the transaction, that's impeding on my democracy. Please respond.
Oh, we are going to get deep. We're going to get deep here,
yeah,
right?
Give it to me.
All right. So who sets the rules, right? Who says you can or you can't do this? That's the first question, right? And you're right. If you look at PayPal as an example, they do have certain policies, et cetera, right? But if you also look at the anti-money laundering processes that governments have and all of that, you know, there's a lot of stuff around. And certainly most financial institutions have to go through a hell of a long list before they can actually open an account and things like that. Now, that is all to do with anti-money laundering. Now, my own view of that is that's a big fur fee. That's being done more for control than anything else. And I'm not convinced it necessarily adds a hell of a lot of value. But nevertheless, that's the way that the world works at the moment. And it's supported by governments and it's supported by the big financial institutions, right? So then it comes back to, okay, so if you atomize the financial institutions, you know, and if you think of distributed finance and all those things, and you get rid of all those big organizations and you basically have individuals with their ability to be able to throw their funds where they want at any point in time, is that good or is that not good? Well, on one hand, yeah, if it can be done quickly and effectively, then you're reducing the costs of friction in the system, and that's good because, of course, friction is always going to slow things up and it's going to be costly and people will be clicking the tickets on the way through and all of those things, right? On the other hand, the risk is then you actually put it back on individuals, and do individuals always make good decisions or do they potentially make bad decisions? And how are you going to deal with that? Or are you not going to deal with that? You're going to let people do whatever they want, you know, come hell or high water. Now, that's an interesting question, philosophically speaking, right? So Of course, you'd never do anything wrong, and I'd never do anything wrong, but there might be people out there who would be quite happy to do things that are actually, not very socially acceptable or actually, frankly, downright illegal. Are we going to condone that? Or are we going to say there should be some rules and some barriers about what you can and what you can't do, right? Which comes back then to a question of freedom, individuality, and actually what you're starting to touch now on, and this is the critical point, is, well, what's society for? How much of society is a set of rules that somebody else has given us that we have to dance within versus make up our own rules as we go along? Because that then starts to give you a bit of a flavour as to how you think about the way that currencies and other elements running over the top, right? Like it or not, we live in a rules-based environment where, you don't speed more than 50 in an area around here unless you want to get a parking ticket, a speeding ticket. If you go over there, you'll get a parking ticket, etc. So we sort of accept certain rules just because it helps society get along. Now, if you argue that we should just get rid of all those and have complete freedom to do everything, which is what I think you're arguing, what are the consequences of doing that?
Yeah, look, it gets deep. I know I don't have the answer. I just know that I think about the analogy or the quote, and I can't remember who said it or how they said it, but they're basically saying that, and I'm sure you'll know this, democracy is the best of worst.
It's the least worst. Churchill said it.
Yeah, that's the one. Yeah, thank you. There you go. And
one of my
it's
favourite
so
quotes.
I think about the meaning behind it because, you have the two spectrums. You have democracy and communism. And as I was speaking actually to Crypto Crazy, who's in the chat tonight, I was saying in one of my streams with him, is that when it comes to crypto projects, and we're actually talking about Hex or Pulse versus Ethereum. Now, the issue with Ethereum is that you have the Ethereum Foundation, which is kind of like a democracy. And as a result, it's very slow and inefficient when they want to change something. Now we go over to a project like Pulse or Hex, where it's a centralized body that controls exactly how the code is going to be written. Now, on one hand, a foundation looks fairer because it's more inclusive and more people can have a decision on it. But it's so slow and inefficient. And that is democracy. Then you go over to the other side.
Dictatorship. You want dictatorship, I can tell.
Well, no, I can just see the advantages and disadvantages of both. So like when I was in China, I can remember clearly seeing one of the most striking images in my mind in China was they built a highway through a building and they cut the building diagonally in half. And they didn't even bother demolishing the building. The highway was going up with such speed and, I guess, aggression, is that they did not even bother completely knocking down the apartment building that was in the way. And I remember driving on this suspended freeway, so a highway probably about 10 or 15 meters in the air, 6 lanes across. And I remember looking into someone's lounge room. Now, they weren't sitting there. Obviously, the building had been abandoned, but it had been cut in half so quickly that there were still lounges and televisions sitting inside this apartment complex that had been cut diagonally in half. Now, is that fair? Absolutely not. Is it fast and efficient? Absolutely. So, you've got to find this middle ground. But we're not going to answer that now. And we've got a couple of comments in here that I'd like to kind of close off, if I may. A shout out to Toyo Masos. He's put in some good comments there, and there's one that I'd like to actually raise with you, because he says, just a quick question for Adam, which I'm actually going to push on to you. Crypto is a new space that will inevitably be dominated by institutional money. Where do retail investors draw the line to cash out, and what are the metrics to look for? So to me, the hardest part of trading, and not even crypto, anything, and even property, the hardest part is when to sell. Buying is easy because have I got the money and do I have the appetite? Yes, I've got the appetite and the money, I buy it. But when it comes to sell, if something's crashing, you can panic sell and you think, oh, if I hold on just a bit longer, it could go up. Now, if the price is going up, you think, oh, if I hold on a bit longer, it could go higher and I could make even more money. So I would like to ask you in the big picture, whether it's Bitcoin, real estate, gold, shares, when do you sell, if ever?
All right. So let's be clear. There's a difference between what I call investing versus what I call trading, right? I'm an investor, not a trader. In other words, I don't take positions and then trade out on relatively quickly and then trade back in and trade the volatility, right? There are people who do that, but I don't, right? I am a value investor, meaning that I'm looking for long-term value opportunity. And so I do quite a lot of work on the way in. If I'm thinking of a stock, I'll look at the stock, I'll look at the context and all those things. I will then buy that stock and I will hold it, and I will hold it for a reasonable amount of time. If I believe in the story of the stock, even if prices move up or down, we had a big crash when the coronavirus hit. A lot of people bailed out of the stock market when it dropped 25% and then regretted it because, of course, it went straight back up again. Right? No, I didn't. I knew that my fundamental investment strategy was to stay with long-term value assets, right? And I then hold them. So I hold a number of stocks in various places that I've held for a long time because they are fundamentally good long-term value stories. Now, if for any reason the value story changes, so for example, if there's a new regulatory environment or something else happens, then you obviously need to sort of check it out, right? So, but that's what I do. But I am not a trader, right? But there are a lot of people who are. The trouble is that people who are traders often claim to be investors. And the other thing about traders are this, that there is a bit of a tendency, if things go against you, what you do is say, well, the next trade will fix me up, right? And then if that doesn't work, well, the next trade will fix me up. And there are a few examples. There was a guy in the UK some years ago who broke a bank. And the reason he broke a bank was because he took positions on a trading desk and then kept believing that the next trade would solve the problem. And it went on and on and on. And it got to the point where the trades were so huge and he just didn't ever solve it. And basically it blew up the bank. Now, traders have this innate belief in their ability to always win, right? Unfortunately, my experience tells me, well, remember what we said earlier on? There's a winner and a loser on every side of every trade, right? So, you could be right, you could be wrong. And in fact, quite often, a lot of traders are right 50% of the time, but no more than that. So there's a fundamental question about value investing versus trading, right? So I'm a value investor, and I've been involved in that for 40 years or so and done reasonably well off the back of it. The other point to make is that if you are in a situation where markets are high, as for example stock markets are now, then I'm probably less likely to go in if I think the value is actually, full, right? I will look for opportunities to come in when prices are down. And so if I've got a value lens, I bide my time. And actually, I'm prepared, waiting for the next crash. There will be a crash in the stock markets, not sure when it'll be. I'm ready to pounce when prices come back 20, 30, 40%, right? Because I think that's the way you do it. So that's my philosophy, and I've used that for years and years and years. But it's very different from what a lot of people are doing, and particularly a lot of newbies who actually are looking to trade and, come out quickly and, trade the next rumor and stuff. That's a very different philosophy. It's not what I would do.
Now, what about the theory so Michael Saylor's been pushing this a lot lately. So buy Bitcoin, and if we don't like Bitcoin, we'll say buy a downtown apartment in Manhattan. So it's a big block of something that is worth something that goes up in value, whether it's gold, stocks, property, Bitcoin, whatever. We have this object that is constantly going up in value.
What, up and down?
Yeah, but aggregate over time. So, let's look at the real estate market as an example. So New York property doesn't always go up. Sometimes it pulls back.
Correct.
But over time, it goes up in value.
Yeah, roughly in line with inflation over the long term.
I don't think that's fair to say. I don't think property goes up just in line with inflation.
You look, give me an example. Look at Perth prices. Look at Perth prices over the last 20 years, right?
Yeah.
Just use that as an example. If you actually even it out,
Yeah.
it's the rate of inflation.
I would argue, respectfully, that Perth is probably a bad example in the sense that it was riding on the back of a massive mining boom. And I was in Perth during the mining boom. I mean, it went for a while, but I remember driving along the beach because there's a road that goes along this beach just forever.
Yeah.
And I remember everyone wanted a beach house. So they just kept building beach houses up this endless highway that just went forever and ever and ever. And each house was worth as much as, if not more than the next one that was going on. But of course, then when the mining sort of pulled back, you had these houses all the way at the end of the road that was like miles away from Perth, but it was still a beach house, and that went down in value. So let's, for argument's sake, okay.
Sorry, that was a bit red herring, but I couldn't resist.
That's why I love having you on here. Okay, so what Michael Saylor says is that you never actually sell these assets. You borrow against them, because if you sell the asset, you're going to pay a capital gain tax in it. He says, as mega rich families have done for years, they own a block down in New York City. When they want 50 grand, they don't sell 50 grand worth of unit. They go to the bank and say, can I borrow $50,000 from you? The bank says, what collateral have you got? You say, I've got $100 million worth of downtown property in New York. They're like, cool, here's your $50,000. The $50,000 there is not taxed because it's a loan instead of an income. And then you pay back that money with the revenue that you're making off your rent. Now, with that model in mind, what are your thoughts on never selling certain assets and just only ever holding them and borrowing against them?
Well, so you've got to do the math carefully when you borrow against them, right? I mean, interest rates are really, really low at the moment, and so there is definitely a potential to leverage. Now, I must be honest, I'm somebody who is anti-debt. Now, when I was younger, I got a mortgage, I paid it off, and I don't ever get into debt now. That's just part of my basic philosophy. That may be old-fashioned, and a lot of people would say, oh, that's stupid, because you can get a lot of money cheaply and you can go and invest it and you can buy multiple properties, etc. Well, you probably can, but philosophically for me, that ain't right for me, right? So that's the first point. The second point is, what I worry about with debt is that people are very quick to take debt, but often they don't think about how they're going to repay the debt. They might be able to service it, and the interest rates are really low, but that's fine. So in property, that's a really important point, right? Because quite often, it's when people suddenly realise that debt is still outstanding, and they're moving to retirement, they've still got this massive mortgage, they've not really paid it down, and then suddenly they think, oh, how am I going to do it? I've got to sell this thing now, whether it's a good time or a bad time. Now, it might work, it might not. So I think there's a place for it, but I do believe that it's not a silver bullet. And I do believe that, unfortunately, we've got a societal set of values from Hex onwards that says debt's fine, more debt's better, leverage up, feel free, no problem at all, right? But I do think there are some risks, and I have seen many, many people get burnt. And remember this, interest rates are really, really low at the moment. There is no guarantee that they're going to stay this low. They might be in 5 years' time quite a lot higher. I don't know. It might be lower, but there is some uncertainty. And it's interesting, in my surveys, when I talk to households who are struggling with debt, around 41% of households are in difficulty because of the amount of debt they've got. Right? It's the same old, same old. They've leveraged themselves up. They've extended the amount of debt they've got to the point where it's rather unmanageable, and then something happens like, oh, less hours, or my income hasn't gone up. So there are more risks attached to it, generally. So I'm cautious.
Robert Kiyosaki is big on building wealth through leveraging off debt. And let's face it, when you buy a house, you typically get into debt and pay it off, and then you've got this asset. But of course, what typically happens is people borrow against that house. So I remember a certain friend of my life whose parents used to just constantly borrow against their house and constantly travel. And it appeared that they always had this cash, but all they were doing was digging the equity out of their house and putting it into overseas holidays. Now, their argument was when they die, they're taking it all with them. And,
absolutely.
Fair enough.
Fair enough.
But I've got to admit that the mind game of debt is very powerful. And many times in the financial space, we're so focused on, do step A to get to step B so you'll get outcome C. But many times we don't look at the psychological reality. So actually in my book, which is focused on trading, 28 Pro Trader Tips, The Art of Trading, a lot of my book, I actually talk about the psychology of trading, the emotion of trading, the fear and the pain of trading, and the things to consider with trading. But when we go into investing, whether it be property or, borrowing, I remember once the Commonwealth Bank actually offered me a loan to borrow money from them to give it back to them to buy their shares. And I said, I'll think about it. And then I think a year later, I said, I'm interested in that. And I said, no, we're not doing that anymore. And I thought, wow, what confidence does that show in your own organization that you won't lend your own money to invest back in yourself? And that told me that, no, they didn't have confidence in their own product. But that's a bit of a diversion there. The reality is that debt is immensely stressful.
Yep.
And I acknowledge what you're saying about you don't like debt. I don't like debt. And most certainly over the last 2 years, my cash flow has increased considerably. But all I do is I just reduce any debt I have. It's a great feeling to not owe anything on a car, to have nothing on a credit card, and have a small amount on a mortgage, or an investment property, which can be offset, for tax purposes. But the reason why I don't find negative gearing is attractive at the moment when it comes to investing in property is because the capital growth in the properties doesn't really seem to add up comparative to the growth of the nominal value of the house going up, the inflation of the dollars that it's compared to, and the amount of expenses that I have to put into that house to maintain it, combined with the risk of tenants not having a job because of the flu, so they can't get money. And then you have another layer that you've seen what's happened in America, which is very alarming to me, where Americans in a certain state were not allowed to evict their tenants who couldn't pay the rent. But so the landlord had to take on the debt that their tenants couldn't pay the rent. So the logical thing would say, all right, well, banks, the government has told me that I can't kick them out. So therefore, banks, you can't foreclose on me. But the government said, no, the banks can foreclose on you. And what the argument was there was that, in fact, this was a way of attacking the middle class. The middle class people who have worked very hard, saved up a lot of money, bought an investment property. The tenant in the house cannot pay the rent anymore. Therefore, the landlord cannot pay the mortgage. The tenant is not allowed to evict the landlord is not allowed to evict the tenant, but the bank is allowed to foreclose and get their money. So the big people always win.
Absolutely. You've made a really important point, which is what I was going to come to, right? If you look at who are the winners and losers in all of this, right? It is the large financial institutions, right? Sometimes I say to people, do you realize that banks think of you as a series of cash flows, right? A series of cash flows over 20, 30, 40, 50 years, right? That's how they think about you, right? They actually don't want you to pay off your debt. What they want is you to continue to pay and to pay and to pay, right? And those cash flows, net present value of those cash flows give you the value that you are to them. Now, once you start thinking like that, sure, you can have a credit card. You might pay 16%. You might pay 26% on the debt on that credit card. People do that, but they never stop and think, how much is that really costing me, right? And if you think about in property investing, I do a lot of analysis of property investors. Most of the property investors I speak with have never done the cash flow to understand whether their property investment is actually paying back or not. And most of them will only look at what's called gross rental returns, which is the capital value that they would pay for the property versus the total rental that they get back. They don't think about all the interest costs and the maintenance costs and the other things. When they put that in, a lot of people are underwater, right? Many property investors, even in places where property values have gone up a lot, are still underwater. Property investing doesn't make a lot of sense if you want to, frankly, maximize your the returns. But again, you see, it goes back to this sort of philosophical question. People don't ask the hard questions. They don't ask what is it really costing me? What is the opportunity cost that I'm actually incurring by doing that compared with doing other things, right? And do you remember what I said right at the start of the show? I don't try and tell people what to do, right? Because, people will make their own decisions. But it's really, really important that people get the information to be able to make good decisions, and that they actually are challenged with some questions that perhaps quite often they don't want to ask, right? Which is, what is the real cost of this debt? What is the alternative, right, to this? What if the counterfactual plays out and things don't go the way that you expect? Those are sorts of questions which smart people do ask, right? And, there's some people in the chat saying, well, billionaires always borrow big and, it's all debt. Well, that may well be the case. It may well be the case. They might have leveraged themselves up and been able to convince the banks to lend big, etc., etc. That's fine. But you've got to be comfortable with yourself. And at the end of the day, my own perspective is I want to be able to sleep at night. I want to know where my investments are and why I am where I am. And I also am basing what I'm doing on a particular perspective in terms of what I think is important for me. And, not having a lot of debt is quite helpful as that's concerned. But people make different decisions, right? And I'm not saying I'm right for everybody, but I want to challenge people to ask themselves those hard questions.
Yeah. And I for me, that I saw someone get arrested today for not wearing a mask because of the flu. And it got me really thinking about what control do we have when they want us to get the jab. Now, I don't mean to bring this in, but it links back to money. Bear with me. So, in my opinion, you're going to have workplaces, it's already happened, saying that if you don't get the jab, you can't turn up to work.
Yep.
Now, on one hand, you can say, well, stuff you, then I'm not going to come to work. But the reality is, if you've got a mortgage and you've got to feed the kids, you need money from somewhere. So one way of influencing behavior, of course, is through money. And I've said that the two greatest motivators in the world are money and fear. That is, I can get you to do almost anything with money. Like, go smash that window. No. Well, I'll give you $1 million if you smash that window. And you're like, $1 million to smash a window? I can replace the window. I can apologize. All right, I'll go smash the window. But then if I said, go hurt someone, they're like, you'd say no. I'd say, well, I'll give you $1 million if you hurt someone. Say, no, I'm not going to do it. But then if I held a gun to your loved one's head, that's fear. So then the greatest motivator is fear. But now we're in the situation where you have money and fear mixed together. That is, if I don't get this needle, or I don't do this, or I don't do that, then I don't get money. And if I don't get money, then I'm scared that I will lose my house and my food and my freedom. So certainly when it comes to debt, I guess what I've really thought over the last few years is that when I don't have any debt at all, I have much more freedom. I have much more freedom because I've got less fear. I've got less fear of losing my job, particularly if I've got other cash reserves elsewhere. So I think we really do share those values. Martin, I am cognizant of the time. Geez, I'm now very cognizant of the time. I want to give a shout out to Vaka Thin. He was the first, or they were the first one there. And I just want to ask quickly, they've asked a question. Did you see my interview with Charles Hoskinson?
Is that, you're asking me?
Yeah, I'm asking you.
No.
Because they've asked that.
No.
So, yeah, I just put it, Charles Hoskinson was the creator or founder of Cardano. He also worked on Ethereum in the early days. And the point that Vaka makes is that Charles, on the topic of how crypto can be so much more than a quick buck. So I'm going to give you some homework. I'll send you a link to that interview. It's only 2.5 hours. I'm sure you can afford to watch it in double speed. But yeah, he articulates very well.
You in double speed.
I know, I'm guilty. To those out there who have seen me publish videos in 1.5 speed, it's because I always listen to my videos in double speed. So when I release them in 1.25, I think it's not an issue. But Martin told me that I shouldn't do that, and I won't do that. Martin, look, it is getting late, so I will close off here. But can you just plug your products? If my viewers want to get to know more about Martin North and learn from you, where can they go?
Okay, so my YouTube channel is called Walk the World. And on there, you'll find daily shows on finance and property and philosophy and all the things that we've been touching on here tonight. I cover crypto and other things too. And I've also got a blog at digitalfinanceanalytics.com, and I post there as well. And from there, you can get to my podcasts and also to some of my other work as well. So, and the point about our conversation tonight is it's a really good example of freewheeling and just thinking about some of the issues that are out there, right, without being too prescribed about what you can say and what you can think. And that's a really, really good advert for the way that I try to do things on my channel, because I believe there are too many YouTube channels out there spinning a yarn. Maybe it's because they want to sell you gold or whatever, or a particular crypto solution or whatever it is, right? I want people to think bigger and broader. I want people to make better decisions by getting more information, to look at multiple perspectives, right? I'm not trying to point a particular solution to people, but what I am saying is act like grown-ups, think like grown-ups, get the information to be able to actually think more broadly. And actually, that can make you freer, and that can make you make better decisions, and perhaps also allow you to avoid some of the, the stuff that's out there that frankly is I think, well, spinning a yarn is probably putting it politely. I think people are being conned. And it goes back to the show we did on my channel a week or so ago, talking about the scams in crypto land. There are some, but folks, you understand, I am not anti-crypto in any way whatsoever. What I do believe is there's a huge opportunity for this down the track, but it's also important that people go into it with their eyes open, and that they understand that we're in the very early stages of this evolution, and therefore don't necessarily swallow the hype holus bolus, right? Do your own work, do your own analysis, and make better decisions. And if you do that, then you're going to come out better ahead.
Yeah, thanks, Martin. And most certainly, I encourage everyone, don't be scared of debate. Like, too often we've seen debate shut down because we just don't want to hear the other side. And I say the reason why people get scammed, it's not because this is the breakthrough that I've had. The reason why people get scammed, it's not because they're dumb. It's actually because they're lazy. And hear me out on this one. It's because they didn't do their research. They didn't hear the other side. Now, of course, there's going to be bad investments, and sometimes investments just fail, and that's part of investing. Yep. But scams is, I really believe, is when you don't take the time to actually look to the other side. It's intellectual laziness. You've really got to dig in. And if you really believe in a product, as I believe in as much as Bitcoin, I want to go to someone like Martin and Peter Schiff to hear the other side, to even check my own work, to question myself. Now, if I come out of a debate with you or Peter Schiff or anyone who's for or against or in the middle ground of crypto, it can only do one of two things. It can make me see the truth, or make me realize that my truth is even more robust than I realized before. And in any case, I can't lose. So thank you for creating the space for healthy and robust debate. Thank you for allowing me to venture into your world. And also thank you for coming into my world here on my channel. And a shout out to all the viewers out there. I do apologize for the stuff around at the beginning of this live stream. It was completely my fault. And if it wasn't for Martin, this wouldn't have happened. So Martin, thank you so much for joining us, and thank you for saving the day.
Glad to be of help. Glad that the system's held up, and we should do it again sometime, because there's always more to talk about. And thank you very much for the opportunity to come on your channel. Enjoyed it, and I'm sure we'll talk again soon.
Thank you, Martin, and thank you to all those who are watching. Give us a thumbs up if you got any value out of this. I'm Adam Stokes. Thanks for listening. Happy investing, and I'll talk to you next time.